invite up Jeff Green from the trade desk to have a chat. So as a sort of like a lead in here, 2 years ago, hey, how are you?
Doing well, how are you?
So 2 years ago, we launched the Digital Marketing Summit. We had been doing the Digital Media Summit on the East Coast, more sort of media and ad tech centric. And we wanted to launch one here because we had a lot of clients in the Bay Area, because we wanted to specifically address some of these issues around MarTech, not necessarily just ad tech and media. And third is we wanted to sort of draw out the distinction between the two. And I joked at the initial one, referencing the relatively low valuations that were taking place in ad tech, rather 1 times revenue, now very nostalgic how high they were. And I noted that this was a conference that was focused on software solutions for companies that tended to have much higher valuations. I said, welcome to the 10X conference. And that got tweeted 100 times. You, sir, have managed to do both, coming from ad tech and have the much higher sort of MarTech valuation. So in case you didn't get the memo, Jeff,
okay.
Ad tech is dead or dying.
Oh, yeah.
Take rates are being commoditized.
Yeah.
There is no way to compete against Google and Facebook. And valuations are in the pits. So how do we explain the trade desk?
So there was definitely that feud that was taking place as we were going through, especially NDRs as we're about to go public. And then during the roadshow, there were so many discussions about valuation. There was this moment in the roadshow where they were pushing back on the concept of SaaS, really, and the response that, and maybe at the moment I was being just a little bit defensive, was I think we have a better than SaaS revenue. Mm-hmm. And the guy's like, what? And my response was, really, the thing that SaaS is so great at is they charge you a subscription and that creates recurring and predictable revenue. But the challenge with subscription prices is that you agonize about what to charge your customers. Mm-hmm. And when you provide so much consumer surplus, especially for big agencies, in order for me to capture some of that and make as much money as possible, I'd have to charge WPP $10 million a seat. But a small agency in Kansas City, I would charge $1,000 a seat. And so how do you reconcile those? So instead, of course, we use a percentage of spend with CPMs caps, and we give lots of quantity discounts. But what we've done is we've given up just a little bit of certainty to make more money. And so when they say, well, why is it better than SaaS? I say, well, I have better EBITDA margins than every publicly traded SaaS company in the world. I have 95% client retention. Right. So I'm giving you all the recurring and predictable, and I'm making more money. When you put all that together, it's a better business model than what I could with SaaS, given the industry that we're in. And I think over time, people on Wall Street have come to believe some of the things you were talking about earlier, which is this is a $1 trillion industry in less than 10 years. Mm-hmm. It's ridiculous to think that any 2 or 3 companies are going to own all of that. Right. And that when you're looking at a $1 trillion industry, there is so much opportunity for people to make money, and they believe that because of the net consolidation you're talking about, the winners are already in the game, and they believe that we can be one of them. So that's easy to sort of talk about in hindsight, but as you were planning your IPO, the markets, as you saw, were in the pits. Everyone was trading horribly. I mean, what was the calculus you went through to figure out that a public offering was in fact in your best interest? Oh my God, it was agonizing. I literally lost a bunch of sleep over it, and part of it is just psychology in the sense that I fundamentally believed that we were more likely to be successful as an independent company than if we sold to somebody else. Mm-hmm. I sold my last company to Microsoft, and that didn't increase our chances. Even though they have an amazing balance sheet, it's just harder to get things done. In the esoteric world that we play in, we thought the same thing was true of really any acquirer, at least at the stage that we were at then. And you sort of dig deep and say, since I believe that, as well as I love what I do, how do I get to the place where we want to be as a company, which is to change the way advertising is bought? A bunch of people, a bunch of bankers on Wall Street or fund managers would say, wait till somebody goes out and is successful. It's just too much risk. Right. And then we said, well, who in the world could that be? And especially if you believe that that net consolidation is happening, there's going to be more pain. And as companies that are already public are struggling and are going to struggle even more, it doesn't seem like waiting is the best way to win confidence.
Right.
So we said we've got to go out. We're gonna take a hit, which we think we did. We think our company went out with a valuation that wasn't fair. We thought our company was worth more than that.
Right. You had to lower the range.
We had to.
Before, yeah.
Well, no, we raised the range all the way along, but we went out with a price that we did not love.
Right. Okay.
And then we constantly raised it, and and follow-ons we actually priced above every range that we've ever set. But we knew that we were going to have to take at least a year to win the hearts and minds on Wall Street and to win trust and convince them of the viability of an ad tech business. And we think we've done that.
Are your public investors, do you think they're ad tech investors or are they growth company investors?
So I've had some of our biggest shareholders say, never say the word ad tech again. Never, ever say that.
Right.
In fact, one of the fund managers at Fidelity, I was asking him, what do you think on the ad tech thing? He's like, I don't think you can avoid it. Like, there's not you can't call it something that it's not, but you've got to redefine it. And so we've spent a lot of time, we still use the phrase because we think we have to redefine it, but that's not what they're investing in. I think they look at us as a SaaS company with a massive TAM that has a different revenue model than most SaaS companies.
They look at you as a SaaS company unbridled by the limitations of SaaS.
The subscription. Some people think subscription is the earmark of SaaS.
Right.
Other people think recurring and predictable revenue is the earmark of SaaS.
Right. Okay. But in
with operating leverage and profitability.
So you've done well in the public markets. You've also done well in the commercial markets, taking market share from other media buying intermediaries. And I've heard various sort of variations of people's opinion of why is the trade desk crushing it? Why are you guys taking share? I've heard everything from, well, it's a better tech. I've heard, no, it's because they've committed to agencies not to go around their backs. No, it's amazing service. It's omni-channel. Any insights as to why what you put your finger on in terms of why you're taking share?
Yeah, so there's this interview that Mark Zuckerberg did a few years ago where he was asked why was Facebook successful, and the interviewer kind of annoyed him, which was awesome because it made it so that you sort of got to hear what he really thought. And he basically said, Facebook shouldn't have existed. Microsoft should have built it. Somebody else should have built it. There's all these companies in the world that have tons and tons of resources. The reason we won is because we cared more than everybody else.
Right.
We are just laser focused on making the media buying experience better. And to do that in a way that is not conflicted. And maybe it's partly my Microsoft DNA, but I have a lot of contempt for the level of conflict of interest that exists in most of the companies that claim to be solving advertisers' media buying problems. And so I think the reason that we've been successful is the same reason that Facebook was successful. Mm-hmm. We care more than everybody else about at least that one problem. And as we've aligned our interests with our clients, they believe us and they trust us with their data. It makes us more successful, and we've created this virtuous cycle. You can also say that same thing and that clarity of vision is the same thing that's attracted better talent, and we've had an amazing retention among our staff and an amazing culture, but all of that creates a virtuous cycle.
So I guess two follow-on questions to that. Do you own a gray t-shirt, and how's your Mandarin coming along?
So I opened the conference that I spoke at in Shanghai with the only 60 seconds of Mandarin that I know.
Excellent.
Trying to win just a little bit of trust. But I guess I do own a few gray t-shirts,
okay.
Yeah.
So one of the characteristics, probably the one that we think is most valuable, most useful in this sector is this notion of agility, to the demonstrated ability not to build a good product, but to, at speed, build new products as the market changes. We've seen a pretty dramatic, just in the last 5 years, we've seen a pretty dramatic changes, exogenous changes to the marketplace with the movement from desktop to mobile, the movement away from sort of third-party cookie-based identity towards first party, and even media channel formats to OTT and connected TV. How do you think about agility and your team's ability to migrate quickly to these market changes?
If you don't, you're dead. I mean, we've said from inception, at end state, there is no such thing as a Chinese DSP or a German DSP. There's no such thing as a mobile DSP or a connected TV DSP. We think at end state, there are only global omni-channel platforms. And either you have to become one or you die. And so in order to do that, I mean, we're a 700-person company that has 23 offices around the world. We have to basically support every time zone in the world. And in order to compete with the big companies, one, we have to care more than they do. But two, because of our alignment, where we're clearly aligned with the buy side, it makes it so media companies don't view us as a threat. So this is huge in TV and in the connected TV world.
Right.
Because when we walk into Disney, they're not worried about our YouTube distribution problem. And they're not, I sit on my board is the CFO of Netflix, and it's sort of surreal for the two of us to view Amazon together as a competitor, right? Given that we're not in the same industry at all.
Right.
But it makes it really easy for us to walk into a Disney or an AT&T or a Comcast and say, we don't own a single dollar worth of media, so it's easy for us to be your buy-side partner who's going to bring unique demand and help them get into the OTT connected TV world that they know they have to get into with existential threat to their existence.
Right. So it's like a Caesar's wife kind of reference, and yet we live in a world where there's conflation occurring between the demand side and the supply side. Companies like Xaxis seem to be wanting to be a media player in a world where you're talking about the virtues of remaining sort of independent and pure.
Yeah, I mean, I think for everything, so I think conflict of interest can work for you sometimes, but it has to be huge.
Right. Okay.
Right. So I think, and I often use analogies to the financial markets because I just think they're so much more mature than our market that we can learn a lot from them. But if you're Goldman sells conflict of interest all the time.
Right.
They're like, yeah, there's conflict of interest, and it's working for you. You're welcome. That's why every Treasury Secretary for the last 30 years has come out of here. It's working for you.
No conflict, no interest.
Yeah, right. So if it's huge like that, you can try to sell it. I do think even in those cases, it's often more of a bug than it is a feature. But it's really hard to be a small shop and say, yes, we have conflict of interest all over the place, and it's good for you. So I think the smaller you are, the harder it is to sell that. And so, I mean, in our case, we think you have to be really laser focused, and part of the reason why we've done so well, I think, is that we've aligned our interest with our clients, and people know who we are.
And your clients being?
Agencies and of course their end client, the advertisers.
Okay.
But buy side.
Buy side. So that brings me to, you say you can play both sides if you're big enough, and obviously Facebook and Google are big enough, and maybe increasingly here Amazon. How do you compete against those players that feel like they have like a complete closed loop ecosystem that seems to be performing for demand side?
So there's no question that it's performed, and both of those companies are two of the greatest growth stories, I think, in the history of capitalism, let alone the internet. And I mean, you look at the growth rates, especially that Facebook has put up over the last couple of years, and all of you that invested in Facebook at the IPO will remember like the fear that we felt as investors in will they understand monetization. They didn't give a shit about ads before they went public, and they've become very good at it.
Right.
So, I mean, unbelievable what they've been able to accomplish. But the thing I just am often reminding people of is that what Facebook is really good at is monetizing Facebook.com. And what Google is really good at is monetizing Google.com and YouTube.com. But in terms of like monetizing the rest of the internet, other players, I think, do that better and with more focus and with more strategic alignment. So I don't believe there is any such thing as a walled garden at end state. I just don't think it exists. I really believe that the same economic theories that we've actually been debating as Americans as it relates to globalization And the idea of us just saying, oh, we're going to do our own thing does not work.
Right.
It has never worked. Economically, it does not work. And so what I think will happen over time is that as they have to continually perform to investors' demands and manage expectations, you have to ultimately do the thing that is in the best interest of monetizing those destinations, Facebook.com, Google.com, and YouTube.com. And it's best to get the very most amount of demand you possibly can.
Yep.
And that means that there will be no walled gardens. They're the only two that I think that can sustain them for the foreseeable future. Everybody else, whether that's Snap or Pinterest or whomever, has to change way faster. And the thing that will motivate them to change faster is pain.
Right. Pain.
Yeah.
Are we seeing that pain now?
Yeah, I mean, all you have to do is read a Snapchat financial statement or listen to an earnings call.
Right, right.
Below the belt?
Earlier, no.
Too soon, too soon, sorry.
We talked earlier about this notion of us being in a maturation phase or entering a maturation phase where, you know, the players are we're gonna have a rationalization of this too many companies, I think as depicted on a slide somewhere. So this sort of end game here, do you agree with that sort of worldview that we're sort of migrating towards that? And do you think is that a net positive? I mean, obviously, there's going to be pain involved, but net, is that a positive for the market?
Yes, I'm so glad you're asking about it because I think in terms of tone and word count, this is where we're doing the industry the most amount of disservice at this junction in where we are. We look at, let's pick somebody else, Rubicon, whose take rate's gone from 25% to 15%-ish in the last year and a half, and that's really hurt their stock price. And people look at that and say, oh, it's a tragedy, another ad tech tragedy. This is not a tragedy, especially if you look at it from how we're carving up a dollar to get it in the hands of a publisher, where 10 years ago, we would take a dollar and we'd give 25 cents to a publisher.
Right.
That's a tragedy.
Right.
Taking it so that it goes from $1 to 55 cents, especially when those walled gardens are taking 50 cents-ish and putting it in their pocket, making it so that the rest of the ecosystem is getting more effective, that's not a tragedy. That's amazing. That's great. It's the best time in the history of ad tech. It's the best time in the history of advertising. All of these things are good things, but because the people who are in pain are being very loud about it, and the people that are doing the most amount of good are very busy, I think that the word count, the word count has been so negative, and it's the best time ever.
This is note to self, right? It's why our blog post 2 weeks ago talking about all these companies finally getting killed, going private, getting bought, we call it the great ad tech cleanup because this is a good thing, right? Let's get rid of all that nonsense and net. So we're in complete agreement on that. Final question. You finally made an acquisition. You bought AdBrain. So congratulations on finding the trigger finger. And so now that you've done that and sort of, you know, the world's wide open, how do you think about organic versus inorganic growth? Because, you know, I could make the case that your stock where it's trading, everything looks accretive. So we've got an ecosystem that's suffering in a good way, net, and valuations are down. You've got a juicy stock. How do you think about using that?
Yeah, so it's really easy to be tempted by the fact that, especially when you're producing as much EBITDA as we are, and you're essentially graded on growth, you can look at the surplus EBITDA as free money. So I can easily look at it and say, I could go buy companies because it's free. They're free.
Right.
And you can certainly see how you can buy a virtual reality company at Facebook with 55 employees and play ridiculous numbers. I now sitting in a position where I understand what I'm graded by, I see how companies can do that. But I look at it from a standpoint of the real limiting factor is time. Right. And I have an executive team where I need to deploy the resource of time as precisely as possible. And culture is something that is really, really fragile, and you have to protect, especially, you know, a year ago we had something like 460 employees. Today we have almost 700 employees. When you're growing at that clip, acquiring is really hard to not screw up your culture. So time and culture have been huge reasons for us to say no. We've probably done due diligence on 40 companies.
40 companies.
And we've said yes once.
Right.
And those are the primary reasons that we say no, not money.
Right.
So.
Awesome.
Thank
Jeff
you.
Green, thank you very much.
Really appreciate it.
Awesome.